Well, everybody, we are 75% of the way through the course. Can you believe it? After this week, there are only 3 weeks left. They're going to go by quickly. Oh, I should ask you, did anyone have questions about the course project at this point? No, okay. All right, so let's jump on in here, long-term liabilities. We've talked about current liabilities, right? We had a whole chapter on that, and obviously those are debts that are due within a year. Long-term liabilities are due in more than a year, right? So we'll learn how the pricing works. Long-term liabilities basically include loans, notes payable, and bonds. And that might be surprising because we think of bonds as an investment. And they are if you're the one buying the bond. But if you're the company issuing the bond, you're actually borrowing money. So on one end, it's an investment. On the other end, it's debt. And so if it's a long-term bond, in other words, if the principal needs to be paid back after a year or more, then it would fall under this category of long-term liabilities. So you might remember this word amortization. Remember our chapter on long-term assets? We learned how to amortize certain assets. Who can tell me which assets do you amortize? Intangible, right? Physical assets get depreciated. Renewable resources get depleted. Intangible assets get amortized. So that's the same word that we see here, but when you're amortizing a loan, it's different, a different process. It's similar. If you've ever bought a house, when they figure out how much you're going to have to pay, assuming you borrow money, most people do when they buy a house, that process is amortization. They take the total amount that you borrowed, take your interest rate that you qualified for, take the length of the loan, and they amortize how much principal and interest you'll be paying in each payment. So that's basically what we'll be doing with the amortization of long-term liabilities. There's a simple way to do it. Basically a straight line amortization where it's the same amount, but there's also an effective interest amortization that's used very commonly. It is complex. We're going to go through it step by step. I would recommend take notes when we get to that, because when you have to do it on your own, you really want to know what you have to do in every step. Otherwise, it gets confusing. We'll look at journal entries. For example, when a company issues bonds, when they pay out the interest on the bonds, and when they pay off the bonds. How do they journalize each of those steps? And special topics related to long-term liabilities. All right, so as I mentioned, long-term liabilities could include loans, such as notes payable, and they can also include bonds. What type of an organization can issue bonds? Can just any organization issue a bond? So corporations can issue bonds. And government entities can issue bonds. I don't know if I've mentioned this, Hartnell College in the past has issued bonds. That's how we paid for our Castroville Center, our Soledad Center, I believe the nursing building over here. The college district, which really is sort of a government agency, there are no investors, it's not a nonprofit corporation, it's a municipality, it's a community college district, right? So that makes it a government entity. It can issue bonds. And then investors can buy those bonds. So when they do that, then the community college has to pay those investors back and pay them interest. So it's a way for the college to borrow money. So really the long-term liabilities we're talking about fall into these two categories, loans and bonds. Let's see, there can be, I have a feeling I'm missing something here. Let's see. I guess there was only one thing I wanted to point out here is that there are some loans or bonds that do not have interest. So as an investor, one of the things you might be looking for if you buy a bond would be the interest. The other thing you might be looking for, if you could buy the bond at a discount, so you pay a certain amount of money up front, but you get more money back later, that could be another reason to buy a bond. So there are what are called zero interest or zero coupon bonds that have no interest, but they would still be appealing to certain investors. Okay, now I broke my remote somehow. I don't know how I did that, but it's an easy fix. I think we saw last week an example of a promissory note. Am I right? This one's pretty similar. Thank you, Arnold. This one's pretty similar. If one party is lending money to another party, you want to document the arrangement in writing, right? And so a promissory note might say, this is the date that this loan takes effect. This is who's borrowing money. This is who's lending the money. Their addresses, and the addresses are important for legal reasons. You make a loan to somebody, they don't pay you back, you might have to sue them, and you need an address to go and deliver the subpoena, the court documents, right? So you need to know where to find them. The promissory note also says the amount that was borrowed and when the payments need to be made, the interest rate. Let's see if there's any value that was received in exchange for the note. All of that would be documented so that, again, both parties agree, both parties sign to it, and there's no misunderstanding. Now, loan documents are usually a lot longer. They usually have lots and lots of legal boilerplate information that most people don't read. But this would be the basic information here that you would want available. So we know that on the balance sheet, we often separate out the current liabilities and the long-term liabilities, right? Let's look at this particular company as an example. And we've got their data from 2016 to 2017. So take a look at this. Tell me what happened with their current liabilities from 2016 to 2017. It went down, right? Pretty significantly. How would that happen? How would they go from this? Okay, it says it's in millions. So they went from $2.6 billion of short-term debt to only 862 million. How would that happen? Okay. Yeah, they paid them down. They could possibly have refinanced some of their short-term debt as long-term debt, but you notice that their long-term debt also went down. So the most logical explanation would be, yes, they paid them off, which is great, right? Corporations often benefit from carrying some debt. It frees up some cash, especially if the debt they have is at a low interest rate, and they can use that money to earn a higher rate of interest someplace else. The same thing could be said for individuals, but it's different. Corporations get a tax write-off for any interest on their debt. We as individuals, we usually don't get that tax write-off. So as a personal strategy, I would say avoid debt like the plague. Try not to have credit card debt. possible. Try not to have student loan debt, but if that's what you need to advance your career, that's understandable. If you need to borrow money because you're going to buy a house and it makes sense for you to buy a house, that's understandable. If you have to have transportation and you have to borrow money to buy a car, okay, but it would be better if you didn't have to, right? But other than that, stay away from credit cards, stay away from paycheck loans, because the interest rates are so high. It just makes it harder to get caught up. And psychologically, when we have access to credit, we tend to be less careful with our money. If you can just avoid any unnecessary debt, that's better. But for corporations, it is a different story. They get that tax write-off, and they have a lot of other options that they could do with their money. Research has shown that if corporations use some debt and some equity to finance their growth, that tends to lead to the biggest increase in their stock price. Corporations have no debt. The only way they're going to raise money is issuing more stock, and they might dilute the value of their stock. If they do not issue stock, then they're going to have too much debt. So for corporations, a balance of debt and equity makes sense. For us as individuals, we can't sell stock in ourselves, right? Not enough. We should avoid debt as much as possible. So why do you think an investor or an analyst looking at this balance sheet cares that this much of the debt is long-term and this much of the debt is short-term? Why does that even matter? It's all debt, right? So why do we break it down into current and long-term? Let's say it's 2016 and you're thinking of investing in this company and you see that they've got $2.6 billion in short-term debt. That's debt they have to pay off within a year, right? $2.6 billion is a lot of debt to pay off in 1 year. I, as an investor, would be a little worried about that, thinking, what if this company can't do it? They might then go out of business. They can't raise enough cash to pay off their debt, right? And then if you compare the next year, oh, actually, look, they did really well. They paid off a lot of that short-term debt. They must have a lot of cash coming in that allowed them to do that. Great. Or maybe they sold some assets, or I don't know how they did it, but somehow they paid off a lot of debt. So that's great. I would be a lot more comfortable investing in the company in 2017 than I would have in 2016. Now, the long-term debt is not as much of a problem because they have a long time to pay it off, right? But that short-term debt could really lead to some cash flow issues if it's growing or if it's too big. I think in one chapter, didn't we learn the current ratio? Where you take the current assets divided by the current liabilities, right? So that's what that tells you. How much money do they have access to this year versus how much debt they have to pay off this year? That's what that current ratio tells you. Okay. So bonds. As it says here, the bond indenture is a formal legal document. So if you read that word indenture, if you hear that word, it's just the bond document, kind of like the promissory note that has the terms of the loan. The bond indenture has the terms of the bond. Here are some terms that are important. The principal, that is the amount that the bond issuer has to repay when the bond matures. These are typically in increments of $1,000 or more for most bonds, but they could be less in some cases. So in other words, if you buy a $1,000 bond, that is the principal. And that's the amount that the company or government that you bought it from is going to have to repay to you when the bond matures. Now, there are other words for the principal. Sometimes it's called the face value. Sometimes it's called the maturity value, but that all means the same thing. So the bond's going to mature on a specific date, and that's when you get your $1,000 back. And in the meantime, you are probably getting interest, right? Because that's one of the main reasons people buy bonds. Now, that interest rate that is specified is called the stated interest rate. So that's the amount that you are promised that you will get. Now, with stock, there is no promise. If you buy stock in a company, you might or might not get dividends. But if you buy a bond, the bond issuer, the company or government that issued the bond, is legally required to pay you that interest at that interest rate that they stated. And if they don't, you can sue them. But they usually do. The only reason they wouldn't is if they went out of business, right? Which is a possibility. But even if they do go out of business, the bondholders get repaid with whatever assets are available before the stockholders get anything. So even in a bankruptcy, you're better off as a bondholder in terms of your chance of getting your money back than a stockholder. Now it says here the interest rate is called a stated rate, but it can also be called the coupon rate. And the reason for that is it used to be that the bond was a physical document, and when you bought it, you got that document, and it had these little coupons around the edge. You could clip them off every 3 months, send them into the company, and they would send you your interest. Of course, these days, you know, who uses the mail, right? Who has printed documents, right? We don't really do much of that anymore. So it's all done digitally today, but we still have that term, the coupon rate, meaning that's the interest rate that they promised to pay you. Oh, yeah, and the interest is usually paid twice a year, but in some cases it could be once a year, it could be 4 times a year. It depends, right? So this is some of the terminology you need related to bonds. Any questions at this point? All right, here's an example of what a bond certificate might look like. So it gives the year, who issued the bond, the amount, the date it was issued, and when it matures. And again, that's when you get your money back. It also shows the interest rate and how often it's paid, and how much you paid for the bond. So there are some cases where you could buy a $1,000 bond for less than $1,000. So like I said earlier, even if it doesn't pay any interest, it's still an investment because maybe you paid $800 and you're going to get back $1,000, right? So you have some guaranteed growth. Or in some cases, you get that growth and interest. You might be able to buy it at a discount, so you pay less than $1,000. You collect interest over the years, and then you get $1,000, even though you paid less than that upfront. On the other hand, there are some cases where you might pay more for a bond than you're going to get back. So you might pay more than $1,000, hold the bond until maturity, and then you get $1,000. Why would you do that? Because the bond is paying so much interest, you don't mind paying a premium for it. And so bonds get a little tricky. I'm not going to lie. They can get complicated because the price of the bond is inversely related to the interest rate. As interest rates go up, bond prices go down. As interest rates go down, bond prices go up. So it makes it tricky. But we'll go through it step by step. Some more terminology. Are there any questions before I get into any more terminology? Okay. So a debenture bond is unsecured, meaning if the bond issuer doesn't pay you back, you don't have any rights to any particular assets. You would have to sue them, and then through the courts, hopefully you get some money back. But if the bond is secured, then they promised that if we don't pay you back, you get this particular asset. So this came up, I believe, when we talked about current liabilities as well. If you're trying to borrow money from a bank, if you can secure it by pledging your accounts receivable or a building or some other asset that you can say, I'm going to guarantee if I don't pay you back this loan, you get this asset, then the bank will give you a better interest rate. And it's the same thing here. Debenture bonds are typically going to have higher interest rates that they offer to the purchaser because they're not secured. Whereas secured bonds are going to offer a lower interest rate because they're safer, because they are backed up by some other asset. Okay, any questions on that? All right, then we have term bonds versus serial bonds. A term bond gets repaid, the principal gets repaid at one point in time. With a serial bond, you're getting payments along the way. It's a series of payments. Then we have a callable bond versus a puttable bond. Okay, I told you bonds get a little tricky. In a callable bond, the seller of the bond can call it back. Okay, so let's say you're an investor and I, as a corporation, sold you a bond. And maybe you're getting 5% interest that I'm having to pay, right? Because I'm the corporation. And then interest rates go down. So I decide I could go and sell bonds at 4%. Why should I pay you 5% when I could go find another investor and I only have to pay them 4%? So I'm going to call back your bond. I'm going to go ahead and pay you for it now so I don't have to pay you any more interest. And then I'm going to issue a bond to another investor at a lower interest rate. So a callable bond allows the issuer to call back the bond. Puttable bond is the opposite. It allows the investor to say, I want my money back now. I want my $1,000 of face value now. I don't want to wait till the maturity date. And then I, as a corporation, I have to give them their money back. But of course, then I don't have to pay them any more interest after that. So a puttable bond allows the investor to decide to end the relationship. I'm going to come back to these two in just a moment. One more term, a convertible bond. A convertible bond can be converted into stock. So if I sell you a convertible bond and you made a loan to me, right? And I'm going to have to pay you back, probably with interest. But let's say you decide that you want to convert that bond into stock because you think the company is growing so quickly, you'll make more money if you own stock in the company. And then you could convert it from a bond to shares of stock. So I'll tell you a story that happened. You might have heard of this real estate investor, goes by the name of Donald Trump. also former president of the United States. There was a time he had this casino in Atlantic City, I think it's New Jersey, right? Atlantic City, New Jersey. The Taj Mahal Casino. And he had issued a bunch of bonds, but the casino was having trouble. It was about to go out of business. Now, how a casino runs out of money, I don't understand, right? Casinos always make money, but somehow his casino ran out of money. I have my ideas, my theories about that, but that's not the point of the story. So the casino is about to go under. So he goes to the bondholders, says, you know what? We can't afford to pay you what we owe you. You're going to lose your shares. But what we could do is convert your bonds into stock. That will relieve some of my financial pressure because then I don't have to pay you interest and repay you the principal. And I can rebuild my casino, and then you'll be part owners, and I'm going to share the profits with you. And he convinced them to go along with that. So they converted their bonds into stock. And then the casino failed. And they were stuck. Because remember I said, as a bondholder, if the issuer goes out of business, you have higher priority than the stockholders as far as getting your money back, right? And there's no guarantee that you get anything back as either, but yeah, it didn't work out too well for those investors. So anyways, that's an example of a convertible bond that did not work out. But if it's a company that's growing and you're saying, hey, I wish I had bought stock in this company, maybe I can convert my bond into stock, and that'll make me more money in the future than just getting back my principal. Then you have the option to do it if it is a convertible bond. Okay, questions on any of these terms? So callable versus puttable. Which is better for the corporation issuing the bond? A callable bond or puttable bond?
Callable.
You're right. And why is that, Julian?
Because they can take it back if they expect a better opportunity.
Exactly. Because it gives them the power to call back that bond, right? If they issue puttable bonds, that gives power to the investor. Now, why would a corporation do that? If they're better off with callable bonds, why would they sell puttable bonds? It's basically just something that they can offer. But if they're having a hard time selling their bonds, they make them puttable, the investors might be willing to buy them. Or maybe the investors will pay a little more for a puttable bond than they would for a regular bond. Okay. All right. Any questions? Okay, so bond prices, as I told you, they go up when interest rates go down. Yes, and they go down when interest rates go up. See, I have to stop and think about it sometimes because it does get confusing. Okay, so bond prices, they are influenced by a number of things. The maturity date, oftentimes the interest rate is going to be higher on a long-term bond than it is with a short-term bond because nobody really knows what the future holds, but it's easier to predict a couple months from now than it is a couple years from now, right? So usually longer term investments, there's more potential reward, but more potential risk, right? Also, just how risky is the organization? If you are about to go out of business, people aren't going to want to buy your bonds. You're going to have to offer a really, really good discount to convince anybody that it's worth taking the risk. I don't think we cover it in this chapter. You might remember from Intro to Business, though, learning about the different rating agencies, the rate bonds. There's Fisk, S&P, and Moody's. Those are the three main companies that look at companies' financials and say, okay, this is a very safe bond, this is a kind of safe bond, this is a risky bond, so that investors know how much risk there is associated with that particular company. The overall economy impacts interest rates and bond rates. What's going on in the world? The more volatility there is out there in the world, that influences interest rates. The strength of the dollar has a factor as well, because that influences how much the US is able to import and export. So all of those things can go into impacting the interest rate. So here's another term, the market rate, the yield, or the effective rate. Those are all the same thing. That means if I buy a bond today, what percentage interest can I expect to get back between now and the maturity date on an annual basis? Remember that bonds are paid out sometimes annually, sometimes twice a year, sometimes 4 times a year. But we just always use an annual interest rate for simplicity. So the stated rate is what the company promised to pay when they issued the bond. The market rate is what you actually get based on how much you paid for the bond. So as we get into amortizing bonds, you'll see that sometimes we have to take the face value of the bond times the stated rate, but then we have to do a separate calculation for the carrying value of the bond, what it really cost you times market rate. Again, you're going to want to take good notes so you don't get those mixed up when we get to that explanation a little bit later. With investors, they'll use this word yield typically. They'll talk about bond yields. That is the actual rate they're getting based on what they paid and how much interest they're getting. Now, the bond prices, as I said, they're sometimes discounted, or sometimes you have to pay a premium. Later we'll get into why that happens. If the bond is selling at a discount, God bless you. The way we identify that is a percentage that's less than 100%. So if a bond is selling at 0.98, that means it's selling at 98% of its face value. You purchasing the bond would pay less than the full face value. On the other hand, if the bond is selling at a premium, it would be more than 100%, right? So if it's 120%, that means you're paying 20% more than the face value of the bond. Or $1.20 for every dollar of the face value. If a bond is being sold at par, that means you paid exactly the face value. Okay? All right, so here's how we find the interest rate per payment. You take whatever's the annual interest rate and divide it by the number of payments in a year. So if you've got a bond, let's just say the bond is 4%. That is the stated interest rate, 4%. And they're paying the interest once a year. And you're getting 4% per year. But if they're paying twice per year, you would take that 4%, divide it by 2. That means twice a year, you're getting 2%, which equals 4%, right? Or what if they're making quarterly payments? That 4% interest rate, divide by 4. And that would mean 4 times a year, you're getting 1%. Again, it adds up to 4% per year. So that's how you take the annual interest rate and then figure out how much each payment is going to be as a percentage. To find out the amount of payment in dollars, we use this formula. You take the principal, the face value of the loan, okay, times the annual interest rate, and then times the number of months divided by 12. Like we did, I think just last week we did that, didn't we? And that way you figure out how much each payment is going to be. Okay, so let's say it was a $100,000 bond and you have 4% interest rate per year, but you're getting paid twice a year. So 100,000 times 4% would be 4,000 times 6 divided by 12. Since you're getting paid twice a year, getting paid every 6 months, right? So you'd be getting $2,000 every 6 months. Okay, these are fairly straightforward formulas, but are there any questions on these? Okay. Okay, so here is simple interest. How many people know or are familiar with the difference between simple interest and compounding interest? The compounding interest is really cool. If you're investing money and your interest is compounding, you're making interest on your interest. And it has this snowball effect. The longer you let that investment cook, when it's compounding, it snowballs and it can grow really quickly. But we'll get to compounding in a second. This is just simple interest. So if you invested $100 and let's say you put it in the bank, and the bank is giving you 6% interest per year, simple interest. So you would get $6 the first year, $6 the second year, $6 the third year. That's why it's simple, because it's the same amount every year. On the other hand, if it's compounding interest, you would get 6% the first year. So you put in your $100, you get $6 of interest. But then the next year, you get interest not only on that original $100, but you also get interest on the $6 of interest. So now you're getting interest on your interest. So in year 2, instead of $6, you get $6.36. And then year 2, now you're getting $6.74. So the amount of interest you're getting increases every time. And when you compound, when you can invest in such a way that you're getting compounding interest, you can leave that money in there. It really starts to grow a lot faster than it would with simple interest. Any questions? All right. So amortization, now that gets more complicated. Like I said, when we're talking about amortizing a loan, what we're doing is taking the amount of the loan, figuring out how much of your payments are going towards paying down the loan and how much are going towards interest. So think about it this way. If you're the borrower, interest is working against you, right? If you're the investor and you're getting interest, that's good. But if you're the borrower and you're having to pay interest, that's bad. So let's see how it works here. I'm going to zoom in on this so you can see it better. This is one of those. This is where, again, you might want to take some notes. I'm going to cut off the column that says year over here, because you can kind of see each row is a year. God bless you. So let's say somebody takes out a $10,000 loan that they're going to repay within 5 years. Okay. And it's at a particular interest rate. Well, 12%, that's pretty high. I don't recommend taking out a 12% loan, but hey, sometimes it happens. So that would mean if you borrowed $10,000, that's how much you have to pay back, right? Not counting the interest. And if it's 12% interest, that means in the first year, you're gonna have to pay $1,200 just for interest. That's not reducing your loan, that's just the interest on the loan. Now, if we had to figure out what payment amount it would be so that you could make equal payments for 5 years and then be completely paid off, that's a complicated calculation that fortunately we don't have to do in this chapter. They just give us that number. And there is software to figure it out for you. In this case, if the borrower pays this amount every year for 5 years, they will end up with a zero balance. But they're paying more than the 10,000 they borrowed, right? This would be more like about 14,000 if you added it all up. They're borrowing 10,000, paying back about 14,000 because of the interest. So the way we would do this amortization table, we will be doing this in the exercise set. And you might end up having to do it on your own in the problem set. I don't remember, but that's why you want to make sure you take good notes. This is what we would do. We would say, okay, we started off with a $10,000 loan. In the first year, the borrower pays this much towards the loan. We have to figure out how much of that payment was interest and how much was principal that was actually paying down their debt. So what we do is we take their beginning balance, multiply it by the 12% annual interest rate that they agreed to. And that's how we found out that $1,200 went towards interest. Okay, everybody with me so far? Principal times the annual interest rate is your interest. Then we subtract that interest from the payment. The difference is the amount they paid down their loan. That's how much they reduced the principal. Okay? So payment minus the interest tells us how much is going towards the principal. Then what we do is we subtract that portion that went towards the principal from their beginning balance, and that gives us the ending balance. Then we just keep repeating that process. So with year 2, the year 1 ending balance we see here becomes year 2 beginning balance, right? So what we do now is we take this beginning balance times 12% to see how much out of this year's payment went towards interest. Again, we subtract that from the payment to see how much went towards principal, and then we subtract that from the previous ending balance to get a new ending balance, which becomes our new beginning balance. And again, rinse and repeat. And the way it should work, if the loan is properly amortized after the number of years of payments that were agreed upon, there's a zero balance. Now, loans can have different terms. Sometimes your lender will let you pay your loan off early without any penalty. If you took out the loan in year 1, you made 1 payment, and then in year 2, all of a sudden you have some extra money and you're able to pay off the entire thing on the first day of year 2, well, then you're not going to get any more interest, right? You saved yourself thousands of dollars of interest. But not all loans let you pay them off early. But this is how a typical loan might be structured. This is how, for example, if you buy a house, your mortgage would be structured. And let's take a look at some of the patterns here. Notice that their payments are even. And when you buy a house, two basic types of loans if you buy a house. You've got a fixed rate mortgage or a variable mortgage. If you go with a variable mortgage, as interest rates go up and down, your payments go up and down. That's risky. That's how a lot of people lost their houses back in the 2004, 5, 6, 7, 8 period. Because they thought they were getting in with a really low interest rate, but it was variable. And when interest rates went up, all of a sudden they couldn't afford their loan payments, they lost their house. Happened to so many people. But if you get a fixed rate mortgage, you know exactly what your payments are going to be for the entire 30-year mortgage, or I've even heard of 40-year mortgages. You don't know if you rent what your payments are going to be next year, right? Because they could always go up. But if you have a fixed rate mortgage, you know what your payments are going to be the entire length of the mortgage. So if you can get in, you can afford to make those payments as other people's rents going up or their variable mortgages are going up, your fixed rate mortgage is staying the same. That's a beautiful thing if you can make it happen. So this is typical of a fixed rate mortgage, same payment every year. Now, I will mention one thing. A lot of people pay their property taxes and their insurance automatically with their mortgage payment. And those things can change. Your property tax tends to go up over time. Insurance tends to go up. But the mortgage itself, if you have a fixed rate mortgage, does not change. So that's what we see here. We see a fixed payment amount for all 5 years. But look at what's happening with the interest. Out of every payment, they're paying less and less interest because their principal has come down. So the amount of interest that they have to pay goes down. And because they're paying less interest with each payment, the amount that they're paying towards their principal is going up. Arnold, a question? Yes. Go ahead.
So for a variable interest, would that be a good thing in a sense of the interest rates really high? Like for example, if you got a house like a little after COVID.
Good question. Okay. If housing rates are high, is a variable interest rate a good thing? Yes, except that they could go higher, right? There have been, like back in the 70s, I was just a kid, I don't remember it, but there were like 10, 15, 20% interest rates on homes. Now you can, you know, the rates are like 4, 5, 6%, something in that range. So they can go a lot higher than they are fixed. So I would say if you're looking at the two options and you can afford to go with a fixed rate, because if interest rates at some point drop, you could always refinance and get an even lower fixed rate. You don't want to be in that situation where, hey, interest rates keep going up, now you can't make the payments anymore. Good question. Any other questions? Student loans are fixed. If you go through a private, I mean, most of them are federal loans. If you go through a private lender, I think they are also fixed. I've never heard of variable rate student loans. So you don't have to worry about that. Car loans, I think, are normally fixed. But it was one of the things that they were doing in the housing industry to make it so more people could get into their home when interest rates were low, but obviously it blew up when interest rates went up. Okay. So let's practice what we've learned here. Let's go ahead and amortize this loan together. Let me take this little thing with me. So, in fact, what I'm going to do, paste this into a Word document. Maybe an Excel spreadsheet would be better. Okay, and let's see what it says here. You want to borrow $100,000 for 5 years. So we see the 100,000 here, right? And we see 5 years. The interest rate is 5%. Okay. This is the amount of the annual payments. We see the amount here. And we just need to amortize it based on a 5% interest rate. Okay. Let's do that together. So this will be the date column here. So we got years 1, 2, 3, 4, 5. We have the beginning balance of 100,000. We have the cash payment. This would be our annual payment. 23,097.48. Interest expense. How much is going to principal? And ending balance. Okay. So we don't need that anymore. Let me zoom in a little bit so you can see it better. Okay, can you see that okay? Okay, and it's the same cash payment for all 5 years. All right, so if we have a 5% interest rate and we borrowed $100,000, how much interest are we going to have in the first year? 5,000. You got it. Okay. And if this was the amount of our payment, and 5,000 went to interest, the difference is how much went towards the principal. So how would we get the ending balance for our principal at the end of the first year? Exactly. Take the beginning balance minus the to principal amount. All right. Thank you, Suzanne, right? Okay. Gotta find my calculator. There it is. Oh, actually, I could just do it in Excel. Whoa. That's one nice thing about Excel. I could just say equals this minus this. There we go. Okay. And then what would be my next step? Yep, exactly. So the ending balance from year 1 becomes the beginning balance from year 2. Okay. Then what would be my next step?
Beginning balance by the 50%.
Exactly. That was Daniela. So we take, I'll just do it with the calculator so you can see what I'm doing. We take the beginning balance for year 2 times 5%. We'll call that $4,095.13. So that's how much is going towards interest for year 2. And then we just do the same thing, right? We subtract that interest from the cash payment. To see how much is going towards principal, $19,002.35. Okay, it didn't like what I was telling it to do. Let's try it again. There we go. Okay, and then we subtract that amount from the beginning balance to get our new ending balance. $62,900.17. It's a little time consuming, right? And it's a little confusing because if you make a mistake, it's going to throw off your numbers. So what you would want to see is that your beginning balance continues to go down. Your interest expense would keep going down. The amount to principal would keep going up. And your ending balance would keep going down. And what would it end at? 0. Or maybe within a penny or two if there's a rounding difference, but basically 0, right? I'll tell you what, let's see, just for fun, let's see if we can make this into a formula. So if I say that this field equals that field, and then this field equals that field times 0.05, and then this field equals the payment minus the amount that went towards interest, and this field equals the beginning balance minus the amount that went towards principal, I can copy these formulas and it'll do the rest of the calculations for us. So if you know how to use Excel, you might want to use it in this chapter, save yourself a little time. If you get the formulas right, then you should end up with a 0 balance. Okay? Any questions on the loan amortization process? Thank goodness there's software that does this, right? So if you work in accounting, you wouldn't be doing this manually, probably ever. But it's good to understand what's going on. So let's go back to the chapter. Let's see what's next here. Oh, an exercise. Okay. Exercise number 1. All right. Aha. Okay. So this one's similar to what we just did. Here, the loan was for $30,000. So that is the beginning balance. It's a 4-year note payable. We see the 4 years right here. The interest rate is 4% compounded annually. Okay. The payments are this amount, and that's for every year. So I'm going to put the same amount under payment for all 4 years. So what you get to do, and you can work together on this. I'll give you 5 or 10 minutes to work on it. Try to figure out the interest, principal, and ending balance for each year. And since it's a 4-year loan, we should end up with 0 at the end of the 4th year. Okay? Any questions on what you need to do here? Okay, well, good luck, everybody. Okay. So any questions on this exercise before we move on to the next part of the chapter? Okay. Well, let's see what's next then. Oh, now we have a problem. This one won't take us as long. Oh, where is it? It's not there. It's here. Okay, so let me open up the problem set. Chapter 13, and it's problem number 1. Okay. So let's read through this together. The company borrowed $150,000. They signed a 5-year note with a 10% interest rate. The payments are $39,569 per year. At the end of the year, First thing we have to do is journalize the note. So when the company borrowed the money, it's a debit to cash because they got the cash from the lender. And now they have a note payable, right? A long-term, well, in this case, it's long-term debt called a note payable of $150,000. We know the liabilities increase on the credit side, right? So journalizing the original note is pretty easy. Now they're asking us for the very first payment. When the company makes their payment of $39,569 at the end of the first year. Since they're paying cash, it's a credit to cash. We have to figure out how much of that first payment went towards interest and how much went towards principal. So with what we know, how much of their first payment went to interest? You might not even need a calculator for this part. These are nice round numbers. How would we get the interest for year one? Okay, multiply the principal, the amount that they borrowed, by the annual percentage rate of 10%. What does that give us? 15,000. That wasn't so hard, right? And then if we just subtract that from their payment, the rest is the amount that went towards principal, the amount that paid down part of the note. And that would be 24,569, right? If you just take the total they paid, you subtract the 15,000, they paid down their note by 24,569. That's it. Done with number one, problem number one. Okay, and what's next? Did anyone have questions on that one? Okay. All right, so we just amortized a couple loans, right? Now let's look at bonds. As it says here, when bonds are amortized, so the same thing we did with loans, we can do with bonds. When you amortize a bond, the premium or discount, if there is one, because remember, some bonds are sold at par value. There's no premium, there's no discount. But if there is a premium or a discount, you include that in the amortization process. The discount is considered an interest expense. So if I sell a bond, a $1,000 bond for $900, I'm saying if you give me 900, I'm going to give you back 1,000, right? So I sold it to you at a discount. That $100 increases the cost of the bond. So that discount increases the interest expense. On the other hand, if I sell you a $1,000 bond for $1,100, now you're paying a premium. I'm getting extra money. And that reduces the cost of interest. So premiums decrease our interest expense. Okay, any questions on that? So as I mentioned earlier, we have a straight line way to amortize our bonds, and then we've got a hard way, the effective interest way. We will do both. This is probably simple. Yeah, this is the straight line amortization example. Okay, so here we're issuing $500,000 in bonds. That's the total of all the bonds that we sold. And we got 540,000. We were able to get more from our investors than we have to pay them back. What do we call that? If they give us more money than we have to pay them back? The premium, right? We charged a premium for those bonds. Now, why would they pay us a premium? They would do that if the interest rate that they're getting with us is higher than what they can get from similar bonds out in the market. So if interest rates have gone down since we got our bonds approved, because you have to go through the state and say, I want to sell this many bonds at this particular price. Once it's approved, you don't go out and change it. So if we got our bonds approved and then interest rates in general went down, we're sitting on gold, right? Because we can sell our bonds now at a premium. People are willing to pay extra to get that higher interest rate. So these bonds were sold at a premium, and the interest rate is 10% per year over 4 years. And we're only paying interest once per year. So when we first sell the bonds, we now have $500,000 of bonds payable, because that's the amount we will have to pay back when the bonds mature. So that's called bonds payable. But then we collected a premium. We collected an extra $40,000 from the bond purchasers, right? So that is a premium on the bonds payable. Notice that both of those are credited. Obviously, payables are always credited when they go up because they're liabilities. And that premium, it's there now, it's getting credited, but it's going to go away. By the time those bonds mature, that premium is going to be all gone. And as I said, the premium reduces our interest expense. So that does get a little tricky, but you'll see here how it works. Now, how much cash did we collect from the investors? 540,000, right? They paid us 500,000 face value plus 40,000 in premium. So at the end of the first year, we make the first interest payments. Remember, it's 10%, right? That's what it says up here, 10%. So it's 10% of the face value, $50,000. That's what we have to pay out in interest. The debit to interest expense, credit to cash. Pretty simple journal entry there. But we also have to amortize the premium. Again, the premium reduces our interest expense. So let's see what happens here. Remember, there was $40,000 of premium, and this is a 4-year bond, and we're doing straight line amortization. So what we do is we take that $40,000 of premium, just divide it by 4 years. So we're amortizing $10,000 of that premium per year. And that journal entry looks like this. The premium on bonds payable that had been credited initially is getting a $10,000 debit. After 4 years of debiting it $10,000, what's going to be the remaining premium on bonds payable? 0, right? 40,000 minus 10,000 every year for 4 years is going to bring it down to 0. And notice that when we amortize the bonds payable, the premium on the bonds payable, we're crediting interest expense. So on the same day, we said we had a $50,000 interest expense because we had to pay out $50,000 to the bondholders in interest. But that interest expense was reduced by the amortization of the premium. Isn't this fun? Okay, so that's how, this is the easy way to do it. This is the straight line, easy, simple amortization. We'll get to the harder one momentarily. Are there any questions on these journal entries? The original issuance of the note, the journalization of the interest, and the amortization of the premium. Okay. So let's see the effective interest method. Now this you would use if the interest rate that you are offering for your bond is different from the market rate. That's a situation where you might have a premium or a discount. And actually that's what we saw here, right? There was a premium. But usually you're going to do it like this. I can't really tell you why you would prefer this rate. I mean, this method, but it's the more common method. More complicated, but more common. So we're going to learn this effective interest method. You'll notice it's a little bit like loan amortization. And again, you'll want to take some notes. So in this case, we have a 5-year, $100,000 bond. The stated rate is 5%. The market rate is 4%. So that means people would rather get our bond than go out on the market and get a lower interest, right? Which means we can charge a premium of this amount. So even though we issued $100,000 of bonds, we collected $104,460 of cash, right? So how would we then amortize the premium? Let me zoom in on this one. You can see it more clearly. Not as much as I can fit in there. Okay, so this is how we amortize the bond using the effective interest method. You start with however much money you collected. So that was how much we collected that included the premium that our investors paid, right? Now for the actual interest payment, it's the face value times the stated interest rate. Nice and simple. In this case, the face value of the bonds was 100,000. The stated interest rate was 5%. So we're paying out $5,000 a year in interest. That part's not really hard. Where it gets tricky now, to figure out how much interest we are actually going to journalize here. We take the carrying value, which initially is the amount of money that we receive, and we multiply that by the market rate. Not our interest rate, but the rate out there in the market, which in this example was 4%, I believe. Yeah, it was 4%. Okay, so the carrying value times the market rate. That tells you how much interest you're going to put on your books, right? The 5,000 is the actual amount we paid for interest, but this is what we're putting on the books. And this difference, we take the 5,000 minus the interest on the carrying value, the difference is the amortization of the premium. So that's how much the premium is going to get reduced each time we pay out the interest until, well, actually, let me back up. What you do is you take that amortization of the premium, you subtract it from the previous carrying value to get the new carrying value, and you're going to keep doing that until your carrying value reaches the face value. So if you sold your bonds at a premium, they're going to keep reducing until you get to the face value. So let me go to the next. Oh, Were there any questions here? This shows how you would, it shows the impact on the accounting equation. And also which accounts would get updated in the ledger. So in this case, when we paid out the interest, remember it was $100,000 face value and it was a 5% stated interest rate, right? So we paid out $5,000 of cash to the investors. That's their interest. We still have a $100,000 bond payable because we're not going to pay it back until the bond matures. We had a premium of $4,460 that we had originally collected, right? But we amortized $822. This $822 amortization of premium reduces that premium. So now we have $3,638 remaining. And by the time the loan matures, that premium will be down to zero. And then we have $5,000 of interest expense, but that same $822 of amortization of the premium reduces our interest expense. So we credit the interest expense account, and really our actual interest expense is the $4,178. Okay? A lot of moving parts when you're dealing with bonds. Does anybody have any question here on this slide? The ledger, the impact on the accounting equation? We see cash going down because we paid out cash. The liability we have is the bonds payable. And the premium and the interest expense influence our equity. Oh. Pay attention to the time. 2:40. Time for a break. I'm glad I looked at the clock. Okay, let's take a break.
You knew.